to get some context around all of this, we're going to bring in special co-anchor for the hour, Tobias Levkovich. He's the chief U.S. equity strategist at Citi. Last week, he was one of the first equity strategists to revise his S&P forecast downward. He does think we are in a dip, but still sees the index hitting about 1,400 at the end of the year. So, Tobias, thanks for coming on. Is this that 5 to 7% correction you were calling for?
Yeah, I mean, and could it be a little bit bigger? Sure. If you think about the earlier correction we saw in the year where I think it fell 8%. I mean, to try to sit there and be that specific is probably a little too touchy, but it's more important that expectations have gotten ahead of things. We're starting to see expectations back off, and in fact, we're not seeing panic in markets, which is kind of interesting. People are seeing the market back off. We hit a high intraday when the news of Osama bin Laden's killing occurred of 1370 on the S&P. We're at 1305 or so. I mean, we're not talking about the market even being down 10%, yet the angst that you kind of hear expressed is a lot out of sync with that.
And yet, as Adam just sort of counted us down to the expiration of QE2, do we start to see more of that panic come in when you start realizing support is coming off?
It's not just QE2. I think if we only looked at QE2, you could come to any conclusion you want. I think if you look at QE2, if you look at normal seasonal weakening in the economy, this is not dramatically different. You can look at things like the ECRI Weekly Leading Index, the ISM, things like that. They typically weaken as we go into the summer months. So you get that kind of economic backdrop. You throw in the debate and at some point vote on a debt ceiling. You throw in the fact that estimates have gone ahead of where they need to be and you need to pull them back. So it's more the coalescence of a variety of factors that tend to come together and hold back
markets. So on a day when many people are telling us that the sky is falling, it sounds like you're saying this is a summer slump.
Yeah. Again, we were still looking at 1,400 on the S&P. We're looking at a summer slump. What's interesting, again, and just think about the sentiment factor, people are talking about a soft patch. A year ago, they were talking about a double dip. Even those words are, just terminology-wise, they're different. A soft patch sounds like something fleeting. A double dip sounds, new recession.
Right.
So you can already see it in that verbiage even.
Tobias Levkovich, Citi's chief U.S. equity strategist, has been with us through the hour. And Tobias, during that time, the markets haven't moved much. They seem to still be like treading water around all the levels of uncertainty we've been interjected today with the jobless numbers, new uncertainties. But back to where we left the conversation with the overhang of the debt ceiling. Is that truly something preventing a small business from hiring? Is it truly preventing people from getting in and buying equities right now? This realization that on August 2nd...
I think small business is probably much more focused on uncertainties about what their health care bills are going to be, what's going to happen to rates down the road, but not necessarily immediately. When the investment tax write-offs expire at the end of the year, will there be a renewal of them next year? Those are much more focused on them. What's the cost of capital for the bank as opposed to the financial markets where they can't access anyway? That's different. If you're thinking about it as an investor, you have to care deeply about your cost of money or your cost of capital. We put out a report earlier this week called The Need for Credible Sustainability.
Yeah.
And a lot of that had to do with what is your financing cost down the road, not today, but 3, 4, 5 years down the road. If it's substantially higher, when you discount back that future earnings or cash flow to the present, it changes the intrinsic value of that asset. So should you invest in it or not depends upon what the financing costs will be over time, not just today. And that's hugely important to valuing a stock. If you don't have clarity on what that might be because we either have budget busting problems down the road, a la Greece, and I'm not saying today, but 5, 10 years from now, if we keep going on this spending trajectory, that's a serious problem. And I think markets are very keenly aware of what's going on in Washington because of it.
And in that report, you look historically back at the calls you were making back in 2001 and projecting ahead for the U.S. markets that by 2013, we will start to truly see a bull market return.
We should, because we're going to hit that.
Which makes you sound like an optimist. You're not usually one.
No, I'm not a pessimist or an optimist. I'm a realist. But, if you go back, and the reason we wrote that report was we said when booms and busts break, when we go through the boom and head the bust, we can look back at the 20s and 30s. We can look back at the 60s and 70s. We can look at Japan in the 80s and 90s. And we can see that markets become trading vehicles. And they're phenomenal trading vehicles at times. I mean, it shocks people when we show them from 1932 to 1939. So that 7-year period, there were 5 major bear market rallies that averaged 93%. So you can make money during these tough times as a trader, but not as a long-term investor. If you want to go to the new bull market, you've got to kind of clear up some of these issues. And by 2013, we're going to have to clear up these issues, or the market's going to force it because of what's happening to mandatory spending. And that's where you're going to get, if we don't do it before then, we're going to get to this, for lack of a better term, come to Jesus moment, and we will fix it. I mean, I quoted Winston Churchill's great line of, America can always be counted on to do the right thing after exhausting every other possibility. So we try the easy stuff first, and eventually it will be forced to do something a little bit more aggressively.
You know, when we talk, and we had Jeff Clavier on, venture capitalists on the show, you talk to these guys who are finding opportunities in tech, and they'll tell you, you know, there is capital out there, there is growth, but it's money in search of those good growth stories. Is that something you're seeing play out?
Yeah, but it also explains, for example, why the bond yield keeps going down. People are kind of desperately looking for somewhere to put money to work, and they're desperate for yield. So they're going out, and you're looking at junk bond yields in the 6.6, 6.7 rate today, which doesn't sound like junk or really high yield. And that's tighter than it was. For example, the spreads are tighter and the rates are even lower than they were before we had kind of the credit crisis and the credit bubble perspective. So we do have some element of people reaching, probably taking a little bit more risk than they recognize, and that can unravel painfully.
And that's how you are explaining that interest in emerging market debts or developing world debts.
I think people are looking for growth in developing regions as well, and the fear I have there, not that we think there's going to be any massive growth problem, but rather the expectation for the growth relative to the growth that can be achieved might generate some issues for investors who are kind of reaching, hoping, praying for wonderful returns, and I've never made money on hope.
What are you projecting for the next 12 months as we get into a really important cycle politically and obviously a lot of incentive to spur near-term opportunity?
The problem with spurring near-term opportunities, you need money to do it.
Right. So no packages
and from what we
Congress.
just heard Congressman Garrett say, there isn't that willingness, certainly in the House.
But the bond traders will tell you they are actually talking about QE3, even if economists and guys on Wall Street aren't.
Our contacts with the bond market investors are pretty clear. The Fed does not want to go there, and I think part of the reasons are there's an ocean of diminishing returns if there's a QE3, and there's a second one, which is how well will this go down in Washington? I don't think Mr. Bernanke really wants to go and have that conversation with Ron Paul, for instance.
Right.
That'll go down pretty tough.
So anything move the needle, though, in terms of a payroll tax holiday, in terms of anything like that?
We have that already. I mean, I think it's going to be clarity on clearing up things. And one of the bigger problems with also having unemployment data is the ability to move things from, if you have a job in North Carolina, but you live in Virginia and you can't sell your house, you can't go to North Carolina. So that's probably part of the problem as well.
Housing.
The migration that used to occur is just not there.
We're seeing these headlines out of Europe that they're trying to get yet another package together for Greece. If we see a near-term, I don't know, any kind of surprise on that side, does that clear things up at home in any way?
Not really. Unfortunately, we still have our own issues to deal with. We're going to have to go through and slog through a tougher summer and reset expectations, and then I think we rally into the year end. So it's not the end of the world by any stretch of the imagination. We just have to get through this tougher time.
Get through this tougher time. You're talking about we're looking until September?
You got to watch the data. I mean, I hate to say it. I think usually this whole sell in May can go away. You start turning around October timeframe. But we really track data. I don't try to make those predictions. If the data all of a sudden turns on positively for things we look on and things like sentiment, then we're going to get more bullish.
Are you as confident in data now as you have been? Because I hear so many people say it's a different economy, first of all, than it has been.
Four scariest words on Wall Street. This time it's different.
Right. Well, but then every time we get some sort of economic data point, you get the why this one isn't exactly right or exactly accurate because...
You hit, in my opinion, the nail on the head. I'm not interested in the data that most people look at. Okay, in other words, I'm not interested in what the economic forecast is when it comes in. I'm looking at how markets react to information, and we back test that 20, 30 years. So, for example, our sentiment model is not based on the VIX, for example, which everyone looks at, because that gives you no investor edge. So our data that we look at is things like what's happening on our panic euphoria model, which gets me when I have really good things, it gets me 90% probability outcomes. I like those.
Tobias, good talking to you. Have a great weekend.
Thank you.